Okay, so I have the honor of having Miss Nikki. I don't know why I keep messing up your name. Naineka. Did I say that right?
Yes, Naineka.
Naineka, aka Monique. She's my Monique. Naineka Howard. She's with the Mortgage Maniac. That is a lender, and she is a broker, and she is going to educate us about first-time home buyers, how to get a mortgage, traditional versus non-traditional loans, condo purchases, and she even has a no-doc loan with a 20% down for those people that maybe can't get a loan because they haven't been on their job long enough or they're self-employed. So she's going to educate us about all of that.
All right. Well, I want to make sure everyone can hear me because I have on the headset and we know how technology is. So can you guys hear me? Okay, great. And can you see the screen that says first time home buyer webinar?
Yes.
Perfect. So first off, thanks so much, Vanda, for giving me the opportunity to present this morning. And this is my presentation on first-time home buying. My name again is Naineka Howard, and I am a loan officer with the Mortgage Maniac. Okay, so this is not your ordinary home buyer webinar. Over the next few minutes, I don't think it's going to take me 45. We're going to go, we're going to start building your plan for generational wealth. A little bit about myself. I have been in the mortgage industry since 2019. I am licensed in 3 different states. Coming soon, Louisiana as well. So Florida, Texas, and Illinois. I am with the Mortgage Maniac. I am a mortgage broker. So the difference between a mortgage broker and a retail shop, a mortgage loan officer, like for example at Wells Fargo, Chase Bank, those loan officers are on the retail side. So they will offer their shop's products. So they don't have as many options because they work for a bank and they're going to offer the bank's products. Whereas I actually have access to 14 different banks and growing. So I have a lot of products that I can offer. So I can pretty much find the product that your client will need because I have access to multiple banks. I'm originally from Chicago. So when you scan my QR code, you'll see a 773 area code, but I am locally in Houston. I am in the Copperfield area. I am a Houstonian now. I've been here for 8 years. And I'm looking to connect with real estate agents in an effort of partnering and growing our business. Okay, hold on, it's going the wrong way.
Yeah.
Let's see here. Technology is great, right?
Yeah, when it works.
Until it isn't. Let's see here. I probably have to let that go. Are you serious right now? Give me a second, you guys. Let's just jump over here. Okay. Feel free to take some notes. Hopefully I can answer all of your questions. You can put them in the chat if you'd like as well. Hopefully we have fun and I'm not boring you guys. So let me see here.
Yeah, very interactive presentation.
It's one of my favorites. Okay, so there's normally 8 steps to purchasing a home. That person decides to buy the home is the first step. Normally they will reach out to a real estate agent, and the real estate agent they first ask, have you secured your financing? Because ultimately you want to make sure that they have secured their financing. So the second step is to secure your financing. After that's done, you're going to find your home. You make an offer on the home. Once you're under contract, there's that due diligence period of earnest money and inspections. And then the next phase is closing, of course, after all the negotiations have been done. And you definitely want to make sure your buyer protects their investments with insurance. I get this question a lot, especially in this market. Is now a good time to buy for you and for your family? I'm always going to say it's always a good time to buy because real estate is always a sound investment. Home prices have been steadily appreciating. Buying is usually cheaper than renting in the long term. And I'm pretty sure a lot of you guys have noticed and seen that the cost of rent has increased drastically. And your own is an appreciating asset. Basically, you're just living in it and it's growing in equity. A lot of people don't think about their home as an appreciating asset, but it is an appreciating asset. You build equity each and every month. With the home versus renting, you're able to actually deduct the mortgage interest and the property tax payments on your income taxes every year. Of course, we know you have more freedom to paint, remodel, and do what you will with your home, as long as it meets those HOA guidelines. The key is having a plan and taking the time to carefully evaluate your finances. I want to talk a little bit about buyer's market. A buyer's market is when there's more homes available than buyers. Inside of a buyer's market, there's better negotiation power. During a buyer's market, you'll notice that concessions are normally given because the sellers don't have a plethora of buyers. It's a smart time to buy in a buyer's market. However, we are in a seller's market. There are more buyers than homes available. So you as a real estate agent, you guys have probably all experienced that there's multiple offers on every single property. Seller's market is still a smart time to buy because it's always a good time to buy. So at this point, you'll start looking at your options. Now, when you're securing your financing, you're going to hear your loan officer explain debt to income ratios. You'll hear DTI a lot. The debt to income ratio is basically the debt, the amount of debt you have on a monthly basis, all of those monthly payments, we add them up and we divide that into the gross monthly income. So for example, if you have a $5,000 per month income and your debts are $1,500, your debt to income ratio is 30%, and that's not bad. The next phase is the credit review. Credit scores. A lot of people will say, I looked at Credit Karma. Credit Karma says I have this score. Credit Karma is not your credit score. It's a good place to review your report, to look for inaccuracies on trade lines, and it's giving your score just a snapshot. It's estimating, but it's not the actual score. And 20 points can make a big difference when you're purchasing a home. Your credit score is going to range between 350 to 850 points. So that's your FICO score that I'm talking about. So lenders use these scores as one way to determine the risk of your loan. Lower credit scores equals a higher risk and may have a higher interest rate and a lower risk than lower risk loans. So basically, the lower the score, the riskier the investment is for the lender. The higher the score, they're more comfortable, and it's not as much risk because a higher credit score, of course, is going to show some stability. This is why it is very important to work with your lender before you shop for a home. You want to know where you are as far as your credit report goes and what's on it. It's not the starting score, but the application score that matters. So the FICO scores, 2, 5, and 4 are the actual mortgage scores. A lot of people don't know that there's 2 types of scoring. And if you go to myfico.com, and if you purchase that service, you'll notice that you'll have FICO number with numbers attached to them. 2, 5, and 4 are your mortgage scores. The other scores are actually your consumer scores. So when you go to buy that credit card, or if you look at your credit card account and they give you a score, that's your consumer score. The mortgage scores are much, a little bit more stringent. And we definitely pull from all three bureaus, Experian, Equifax, and TransUnion. The credit report. By law, you are entitled to a free credit report from these three bureaus. It's a great way to check for mistakes, fix them before you apply for a loan. So you can go to annualcreditreport.com and they will send you, you can request a free credit report if before you start to have your credit pulled at a lender. So you can let your clients know if they're not sure what's on that credit report, go ahead and pull it for free. It's not going to give them the actual FICO score, but it will give them the list of the report and they can see the history of payments. They'll be able to see how many trade lines, and just to validate the information that the credit bureaus have is accurate. So with that credit review, we're looking at that FICO score. You want to make sure the name and the addresses and phone numbers belong to you. If there's an address on your credit report that you haven't lived at, that's an inaccuracy that you want to get removed. Disputed accounts is we definitely look at disputed accounts, late payments, how many inquiries, charge-offs and collections, and open accounts. So I'm going to talk about a couple of things on this list. First, I'm going to start off with collections and charge-offs. A lot of people may decide to say, oh, I've got these collection statements and these charge-offs, let me go ahead and pay it. And then they're really wasting money because the damage is done. If you have a collection, a charge-off, your FICO score reflects that already. So it's not as if, okay, well, I'm going to pay them and I should get an increase. That's not how that works. So you want to have the conversation with the credit professional or loan officer to see how making that type of payment, will it affect your credit score? A lot of times it doesn't, unless that credit trade line is willing to delete that information. If the information is going to stay there, it's going to still show the negative impact of that it's in collection. It may show that, yes, you paid it, but if you did not have it deleted, you're not going to receive an increase in FICO score from that necessarily. Also, if it's there, there's a time limit that it can stay there. So you can only have, a business can only stay on your credit report 7 years. If it is 6 years and 3 months and you owe this place $7,000, I think you should wait until it falls off, unless you just have that money, and making sure that they're going to delete it. Sometimes also, if you are starting new activity, you can give that trade line more length of time, whereas you don't want to reset the clock. So definitely make sure you have that conversation. Don't assume if you do something on your own, you should get X amount of response from that, because when it doesn't happen, you're upset because you spent this money and you feel like you've wasted it. So it's very important to talk to the professionals about that. Disputed accounts. A lot of times with credit repair, they dispute accounts. When an account is disputed, you'll notice that someone's credit score does increase, because basically a dispute is saying, hey, this information may not be accurate. So when that trade line is in dispute, the FICO score tends to increase a little bit because it had a negative impact, but now we're saying this may not be accurate. So you'll see some change in the FICO score. However, for a loan officer, when you are in underwriting, we cannot have any accounts in dispute. So I'll go back to my client and say, you need to reach out to the credit bureaus. You have to remove the dispute comments. Once you pull those trade lines out of dispute, your credit score will drop a couple of points. And it's very important as a loan officer, that I have the accurate FICO score to know if you qualify, because if you're at barely qualifying with the accounts in dispute and we remove the dispute comments off and your score drops under 580 or up under the 640 for conventional, then your loan is in jeopardy. So I just wanted to talk about this credit review piece a little bit more extensive. I believe that if your client is in credit repair, or if you are in credit repair, you should have that process completed fully before you jump into getting pre-approved for your home. This 5% is the number that we use for the existing charge-off and collections. So whatever that balance is, charge-offs don't count against you per se. So we can definitely keep them on the account. I just have to calculate a payment as if you're paying it. And if we calculate that 5% and you still fall up under 45%, that's an income ratio, then you qualify with the payments. So why go through the motions if you don't have to? If you're still within that DTI parameter that you need to be to qualify, sometimes I tell my client, let's just leave it as is. Credit review. This is a percentage of what your score is made up of. Having a report is 350 points. It's 35% is payment history, 30% is utilization, age of your credit trade lines, your credit card accounts. The more time you have on the, on your report. If you have credit cards that have been in existence for 3 and 4 years and they're in good standing, that helps. That shows that you have some credit responsibility, maturity. You're able to handle these credit accounts. So it's very important to have some credit cards with some history. Credit mix is 10% of your scoring, and new credit and credit inquiries is also 10%. So you really only need 3 trade lines at minimum on your credit, 2 to 3 trade lines on your credit report. You don't have to have a lot of credit. You just have to have enough to create a credit score, if that makes sense. Pre-approval. Yes.
The 3 trade lines, a lot of people say when they pay off like a car or a mortgage, their credit score drops instead of going up. Is that because one of the trade lines is gone?
Yes, exactly. So basically, when you pay off the car, your score drops because you no longer have that open trade line. It stays there as far as a good history, but what's happened is the on-time payments that you were making every month strengthen your score. Once that installment is paid off, then you're not going to continue to get those points, and so it actually drops. And that's why I tell a lot of clients, if you have it's okay to pay your credit card bill completely off every month. Or if you decide I'm going to just get out of credit card debt, which I think is an amazing thing to do, don't close the credit card. You can have the credit card open with 0 balance. It's the history and that it's in good standing that is going to basically help your credit score.
One thing that happened to me, I had numerous credit cards and then I paid them down. I didn't close them, but then the credit card company reduced my amount, which made it look like I was over the 30%, 35% utilization. So
yeah, you want credit is a very tricky thing. Those algorithms, and I am no way saying that I am a credit professional. I don't do credit repair. That's not my lane, but I'm just talking from experience and what I've seen with my clients. So what I tell people to try to do is, put a tank of gas on it, use it, because if you don't use it over time, they will decrease it. And in some cases, they'll say, hey, you're not using this, we're going to close it. So you do want to have some type of activity, but you don't want to go and max it out. You want to keep it under 30%, maybe 3 to 5%, and just pay the bill off at the end of the month, because that's showing that you're using the credit that you have. So yes, Vanda, if you don't use that credit, they will reduce the allowable credit line, and in some cases they will close it. So when I pre-approve my clients, and when you're pre-approved, you can shop for your mortgage with different lenders. So if as loan officers, you can go to different loan officers, and if it's within that 30-day period, it's considered one credit pool. So the impact on that FICO score has happened. If you go to another loan officer, within that 30 days, you're not going to get hit with another impact as far as point reduction on your FICO score, because we're all in the same industry, and it is your right to search for the mortgage that's best for you. Or you can shop with a mortgage broker like myself, and you don't have to worry about that because I have access to multiple banks. And I can shop multiple lenders for the best deal. So there is a big difference between pre-qualification versus pre-approval. Pre-qualification is informal, and it can be done over the phone. Basically, someone saying, hey, I'm going to give you some numbers. I make about $5,000 a month. My debt is owed about $1,500, and I've been on job 2 years. I haven't vetted any of this information. And I can do a pre-qualification and say, and that basically says, based upon what you disclosed to me, you could possibly qualify for a loan. You can't go under contract with a pre-qualification because nothing's been vetted. There's no obligation, there's no paperwork, and it's just a ballpark figure based on the conversation. Pre-approval is not a formal commitment to lend. However, the lender, I'll collect all of the required documentation and verify your income, assets, and credit, and give you a definite idea of what you can afford. So a pre-approval is better than a pre-qualification because the applicant has been vetted. And so it's not a waste of time. I definitely recommend that you get your clients pre-approved before showing them homes, because it's a waste of your time if this person does not qualify for a home. And time is that one thing that's, once it's spent, you cannot get it back, and your time is important.
We do not show people homes unless they have a pre-approval, right?
Absolutely.
Realtors, right.
So like I said before, we're going to analyze the credit, analyze that debt, analyze income, assets, and all the other needs. I take a different approach when I pre-approve my clients, because I know banks will pre-approve you based upon ratios. But I know as someone that has a family, budgets are different. So I ask my clients, how much are you comfortable paying? And I have a realization moment. If you're used to paying $1,600 to $1,800 in rent, and you want to keep your payments in that area no more than $1,800, then I'm going to let you know you need to look for houses at this price range. We need to be, let's say $315 and under, $280 to $315. If you're looking at homes at $450,000, $420,000, $500,000, that is not a $1,500 mortgage. So I like to have that conversation. And I also like to point out the difference on those mortgage calculators. They're calculating principal and interest. However, you know, as a person, as a homeowner, you have principal, interest, taxes, insurance, homeowner association. So if does that $1,800 that you want to stay under, is that everything? Does that include your escrow account? Does that include the homeowners association fees? Because then we have to start working backwards and dissecting these numbers. So I definitely have that conversation, and then it's a realization for them, so that they know, you know, what can I actually afford? What am I comfortable with? Because I don't want anyone to say, you put me in a loan and I'm house poor. Yeah, I could afford it on paper, but I'm struggling to pay that, because that's not good for anyone. And I definitely want to build a rapport with my clients, because I want a return client. So that's the approach that I take. Some banks will approve you up to the max of what the bank will give you. Documentation is required for pre-approval. We need 2 years of tax returns if you are self-employed. If you are W-2, we need the last 2 years of W-2 statements. The last 2 months of bank statements, 2 months of pay stubs. Actually, I'm sorry, you only really need 30 days of pay stubs. Driver's license and social security number. If you are on a fixed income, that's social security benefit award letter or pension award letter. Child support, if you are receiving child support and you will receive child support for the next 3 years, that is qualifiable income, retirement account statements. If you're going to pull from your 401k for your down payment at closing, you can definitely do so. I would need other documents as requested with that, like the terms of withdrawal for those statements. So there's two types of loan products out here. There's traditional programs, and then there's something called non-QM, which is non-qualified mortgages. Traditional loan types are the FHA, VA, conventional, USDA, reverse mortgage purchases. Non-QM is bank statement loans, non-stated income, no docs, I-10, foreign nationals, commercial, and DSCR. I'm pretty sure everyone here is familiar with the FHA, VA, the traditional mortgages. Bank statement loans, I've done this for my self-employed borrowers because basically self-employed, qualifying income is based on tax returns. As a business owner, you have the ability to write off and expense a lot of your income on just your expenses. Your adjusted gross income is what we use to qualify you. If on paper you told the IRS you made $25,000 for the year, then you made $25,000 for the year, and that's what we use to qualify you. Whereas your bank statements may show a profitable business. So if that's the case, then you'd have to use your bank statements to qualify, and I do have a bank statement loan product. I have a no stated income, no docs product. It is for clients that may have some issues with showing income as far as job history, the 2 years. This program is there, but it requires 20% down. It is a non-traditional product that I have a couple of banks that offer that are offering this. So I-10 is another product I have for someone that does not have a Social Security number but have a I-10 number. They have to have at least one FICO score with that. For nationals, someone that's a citizen of a different country. I have commercial loan products as well, and DSCR is investment loans. A DSCR is for, let's say someone is trying to buy a multi-family apartment building. We can basically use the debt service of the investment properties. So the potential rent from each unit is what's used to actually qualify that building. I'm going to go through this pretty quickly.
I'm sorry, could we go back for a moment to the last slide?
Sure.
What is the down payment usually for the DSCR?
So DSCR is roughly 15% down. Some are 15, some are 20. So this is more for the investors. And I have about 4 different banks that offer them. So I'm going to say as low as 15. I think I have one that's as low as 15. So the loan to value, we can talk more offline and I'll give you some specifics, because what'll happen is loan to value is also attached to where the FICO score is, or if they're doing this in the LLC. So I could give you more information on that, because it's not a blanket across the board, because different banks that offer this product have different guidelines for it. Okay, FHA loans, the government issued loan, we go as low as 580 with 3.5% down. 500 to 579, you need 10% down. Owner occupied homes only, and you can have up to 6% concessions from the sellers. But as we know, we're not in that market. For FHA loan, Chapter 7 bankruptcy, you have to wait 2 years from the discharge in order to qualify. Chapter 13, you can, with the Chapter 13, if it's negotiated at the Chapter 13, you let the judge know, I want to buy a home. If they work that in and it's approved, and if you paid your 12 months of payments and the trustee approved it, you can basically 12 months in a day, because you've already let the judge know and it's a part of the terms of the bankruptcy. Foreclosures, short sale, you need to wait 2 years from the recording date to qualify for FHA. Student loan payments. Student loans are a big issue, but this year, Fannie Mae has changed the guidelines, so we can now use a 0.5% of the balance or your income-based repayment plan to qualify you. So that's huge, because now with this law, more people are being able to qualify for a mortgage. At one point, their student loans were stopping them. FHA is more lenient. You can have up to a 55% debt to income ratio. There is an upfront mortgage insurance payment of 1.75% of that loan amount. You can go up to a 4-unit under FHA as long as you occupy one of the units. So if someone has a duplex up to, I live in Illinois too, so 4 units in Illinois, there's a lot of 4-unit or buildings. If you occupy one of those units, this is your primary residence, and you can rent the rest of them, and you can go FHA with this. FHA also has a renovation loan product. And there's also some energy efficient mortgage out there with FHA. Mortgage insurance premium. It's not affected by credit score. Your down payment is slightly affected by the down payment. If you put more down, because mortgage insurance premium is a percentage, it's 0.85% of the loan amount. So of course, if you put more down, the loan amount is lower. So that's what I mean by that. It's always required on FHA, and it cannot be removed with the FHA loan. So you'll find that some will use FHA to get into the home and then later refinance into a different product so that they can get rid of this mortgage insurance premium. Conventional, you need a FICO of 620 or higher. First-time home buyers can put down as low as 3%. It's normally 5 to 20% down. Now, you don't need a full 20% down. However, if you put 20% down, you do not have to pay PMI. So that's the confusion. People are like, oh, I need to put 20% down. No, you don't need to put 20% down to go to a conventional loan. It's just that you're going to carry that PMI insurance until you paid enough down and your house loan to value is up under 80%. Or the market has increased, you have more equity in your home, you get an appraisal done, and they find that your house is worth so much more. Then if it's your loan to value of what you owe on that home is at 80% or less, then on a conventional loan, the mortgage insurance has to come off. For Chapter 7 and 13, for a conventional mortgage, you have to wait 4 years from the discharge. Foreclosures and short sale for conventional, 7 years from the recording date. The DTI max on conventional is a little bit more stringent. It's normally 45 to 47%, depending on the FICO, but 45 is the number you'll see a lot. We talked about the PMI. Mortgage rates are heavily affected by the credit score and the down payment. We do have some conventional products that are income driven, such as Home Ready and Home Possible. So if you meet a median income requirement, you could qualify for a conventional mortgage through these programs. VA loans, I can go as low as 500 credit score. The great part about VA, it's 0% down. There's a funding fee of 2.3% for first time use. You have to wait 2 years for a Chapter 7, 1 year from discharge on Chapter 13. Foreclosures and short sales, the wait is 2 years for VA loans. The funding fee, the veterans pretty much know about the funding fee. So first time use is normally 2.3% down. Subsequent use is up to 3.6. If they are 100% disabled, they're exempt from paying this funding fee. Of course, USDA homes are based upon where the house is located. And the USDA, this is an older slide. Right now, USDA, you need about a 640 to 660. I need to update that. It's basically the same waiting period as conventional for your bankruptcies.
Do you do a lot of USDA?
Yeah. I do a lot in Dallas because that Forney area has a lot of, they're building in the rural areas out there in Dallas. But I do USDA. We have to run it through a different system, and it is quite particular. So USDA has they have their own system like Fannie Mae that I have to run it through. So yeah, USDA it's a great program, but it's just as, to me, it's just as hard as a conventional loan.
They're building so many homes out here in rural areas that will qualify for USDA that I thought.
Yeah.
Mhm.
Yeah, definitely. If the clients, so here's my thing with USDA, you need to have low debt to income ratios. Your ratios need to be intact because they're more stringent. The front end is 29%. The back end is a 43. So it's more stringent than conventional. And the back end is the total obligation ratio. That's with the mortgage and all the debts you already have, no more than 43% on the back end. That mortgage cannot eat up no more than 29%. And sometimes you'll get an approval based upon the credit history and the credit file, how strong it is, but the set ratios are 29 and 43, and that's more stringent than conventional. But I definitely, if it's in the USDA tract, I definitely try to run it through USDA, see if we qualify, because it's 100% financing. You have closing costs, but you don't have to worry so much about the, oh, I think I'm going the wrong way, you guys, sorry. You don't have to worry about the down payment. I don't want to take up too much more your time. This is too lengthy. I want to talk really quickly about my non-QM products. Like I said, I have the bank statement loan, community program, 20% down, a 640 FICO score. That's the one with no stated income. Because you don't have to show your income, there's no DTI restrictions. I-10s is clients without a social security number, but they have this I-10 number. They need at least one FICO score. And foreign national is a person that's just not a citizen here. But they have 12 months of reserve for purchasing that home. I have a program, the foreign nationals, I do have it. I want to talk about condos really quickly. Condos have lower, are cheaper than a traditional home, a single family home. But if your client is approved for FHA, you have to make sure that it is an approved FHA unit. This information can be provided from the HOA of the condo association. The financials of the condo HOA are taken into consideration for the loan. So when it comes to a condo, it's not just your client being approved. Does the actual unit itself qualify for financing? So you have to make sure you do your due diligence with this. So according to HUD, the property must be completed. If there's a new build, it has to be completely built. Can't have a phase still in construction for FHA for condos. No more than 50% of the units can be used as rentals or be investment owned. This means your client needs to purchase this and live in it for FHA anyway. The property must be insured, and the condo association must keep at least 10% of the HOA budget in cash reserves. So while the condo itself, the building itself may qualify, if the HOA financials are not where they need to be, FHA will not allow it. And that has nothing to do with your client. So you do have to do a little bit more due diligence with condos. No more than 35% of the property can be used for commercial use. So you'll see buildings where there's commercial use at the bottom and the condos are up top. Let me see here.
I have a question. How will we know? We're just putting in an offer. How do we know the HOA reserves?
So there is a survey. As a lender, I reach out to HOA and I request part of the documentation for the condo is a survey. And a lot of times if they're accepting FHA financing on that NMLS, then they know these guidelines. And I requested as part of the preliminary paperwork. And that's what the bank is, that slide is what the bank is looking for. It's a checklist. But if that condo is saying FHA, they've pretty much done that and they know what the underwriter is looking for. So those that do not accept FHA, those are some of the reasons why, basically.
So let's say we have someone contact us and they want to sell their home in a condo, their condo.
Mm-hmm.
How do we know? We're gonna put on their financing, conventional, VA.
So I would have them as a resident of that condo association. They have access. They can request the financials, okay. And you need to let them know. Hey, we need to make sure that your condo is FHA approved. There's a survey. That same survey for FHA condo. You can request that from the HOA. They normally charge for it. They may not charge. I know on the buying end, we have to pay for it. On the selling end, they may have access to it, but they want to reach out to the condo association and say, hey, if I'm going to sell this, I need to make sure, I want to know if it's FHA approved. Do we fit that parameter? Do we fit those guidelines? And I'll let them know, hey, yeah, we're good to go. We don't have so many investors in here. Pretty much we're owner occupied. It's not a lot of rentals because condos are an investor's go-to for Airbnb income. So that's why those parameters have been implemented, and we just want to make sure that the condo qualifies and that they've been doing what they're supposed to do. The other great part about condos is that your homeowner's insurance is less, it's a lot less, because you're just insuring on your policy as the person buying that condo, that space from wall to wall, floor to floor. A lot of the other pieces, a lot of the other insurance is on that master insurance policy because they're common areas. So the homeowner's insurance purchase of a condo is much less than a single family home. And one other piece I wanted to talk about with that is the, but you want to make sure that you know what that monthly HOA fee is, because with the condo, we're going to count that into the DTI because that HOA all HOAs can definitely foreclose on you if you don't pay. But we want to make sure with single family home, HOAs, we don't count it into the DTI per se. I normally put a filler in there just to make sure it doesn't bust the ratios, but the HOA condo fees are higher normally than for a single family home than they are with the condo. Mm-hmm. They're higher, other way around. They're higher on the condo than they are with a single family home.
Right.
Yeah. And so that's pretty much my spiel. Did anyone have any questions?
Can you share with us the banks you work with, and do you work with credit unions?
So right now, as a broker, I don't have any credit unions that I broker through. I have some that I use as a referral because a lot of times credit unions I have better rates on, like HELOCs, lines of credit. Whereas I have a HELOC program, but as a loan officer, you got to do an initial draw. It's like 40 to 50,000. And some people they just want to have the line, not necessarily do the draw right away. So I have some credit unions that I partner with, and I refer business to them. And they also refer business to me because they can't lend as low on the FICO score and I can. So I have, I don't know if you ever heard of United Wholesale Mortgage. I work with Velocity Bank, Flagstar, Cardinal. There's a lot of banks that on a broker channel I don't have the list. I can pull the list, but I work with about 16 different banks. So it just depends on what the client is looking for. Some banks have overlays and our client can't get around that overlay. So we'd have to go to another route. So I love being a broker because I'm dating, and I'm gonna get my client, I'm gonna date this broker and I'm gonna date this bank, and depending upon what my client needs, is going to depict which bank I'm going to go through. That makes sense. Any other questions?
Do you, once you pick them, do you give the client a choice of, you qualify here, here, and here, this is what their terms are, this is what their rates are?
Well, yeah, yes. Before we lock in, so I vet the application a lot, and a lot of times we're going to go with the best route for the client, because I like to keep the process as stress-free as possible. So I vet the situation thoroughly, and I know the guidelines, and so I'm going to talk to my account exec, run it to see if I even want to go through that process, read through their overlays, but I'm not going to give the client, that's really not for them. It's for me to make sure, based upon their scenario, which place am I going to put them in? And I do take into consideration the interest rate. I take into consideration overlays that they may have that may be an issue for my client, depending on the client situation. And if it's a situation where there's 2 or 3 options, I'll definitely lay it out. But I try to vet down and do my drill down to find the best product for them on their behalf. And I know, and also turn times. So if I have a lender that's taking longer than 30 days, I don't like to extend contracts. So what's more important, an eighth of a percentage, which is going to be $3 on your mortgage, or getting this done in 30 days? I think you want to get this done in 30 days. And I'm not going to try to save you $2.20 a month. And we extended this contract because, yeah, they got this rate, but they're moving too slow. So I definitely do my due diligence with that.
Okay. Anybody have any questions?
I know Vanda is going to pass this out, but if you want to scan my QR code, feel free to do so. It has my information there, my Calendly link. I do a mortgage consultation with clients. If any of you guys are interested in working with me, I have a couple of systems that I am loving this year. I have a system where we're co-branded. Let's say I'll give you a link. Your client does an application. I know exactly where this client came from because this link is branded to the realtor. If your client is approved for $350,000 and you're out negotiating, you have access, as long as you go ahead and do the set up your criteria in the portal, you'll have access to the file, and you'll be able to adjust the pre-approval letter up to that max. So you don't have to call me and say, hey, we're looking at this house and we don't want to show how much we want to put in a different amount on this offer letter. Well, you'll have access to that. And that's something that you can do on your own. Time is money. I know a lot of times there's cutoff dates for offers. So that is a great platform. Everyone that I'm working with loves it. Because they may decide to put an offer in on 3 different houses, and they don't want to put $300,000 on each one of those homes. So I definitely try to make the process as easy as possible. And I answer the phone. I do a weekly update on my files, letting you know what's going on. Even if there's nothing going on, you're going to still get the phone call, because that's just how I do business. I call every week and let you know what's going on with the file.
Where's your QR code?
Can you see it on the screen or no? Nope. Oh, no, let me share my screen. Nope. Sorry, you guys.
And you also wanted to talk about Trio.
Yes, I am actually going to do a whole presentation about Trio. I have a program, I am a part of, it's not my program. There is a program called Trio that I work with. Trio is a lease to own program. It is somewhat similar to some others out there, such as Divvy and America Home Partners, but the difference with this product is that Trio, Trio does not change the dollar amount. If your client is approved for a $300,000 home and they purchase that home through Trio at $300,000, yes, Trio buys the home and your client is leasing it to begin with because they may have some issues that are preventing them from outright purchasing. So they're going through this option. Trio doesn't have a big inventory of homes. Your client is approved, they go out and they shop for the home. Trio steps in and buys the home on their behalf. So this deal does not fall out of financing because this company is well established. The company is buying the home. They lease the home back to the client. Once the client is ready, they step in and they assume this mortgage. So whatever equity that is built into the home, they get to keep all that. The interest rate that is locked in at the beginning at the lease is the same interest rate that they assume on the back end. So interest rates are increasing. So 2 years from now, you don't know what the interest rate will be, but to know that your interest rate is going to be the same as when you negotiated this lease is a great feature of Trio. If you want to contact me, I think I'm going to do next week. I'm trying to iron out either Thursday or Friday. I have a full presentation that I want to present on that because it's for those clients, you guys, that are not quite ready. They're still quote unquote, I got to get it together. And the only thing you can do is put them in another lease anyway. So this is a way to get them in a home. And if they do what they need to do, you get your commission and they can go ahead and use this program to just be a homeowner. So it's a really great program. If anyone's interested in that.
How is the lease price determined?
So the lease price is determined on, there's a full criteria on that. I wish I knew it by heart, but I don't. That's why I have to do a presentation on it. But it is based upon the mortgage itself. It's a little bit higher than a traditional traditional lease because a portion of their lease payment is being put to the side to cover down payment and closing costs when they actually assume it.
Oh, okay.
So it's not for that person that doesn't have any money because there is a commitment going in. It's not a traditional lease program. Think of it as an assumable mortgage. So they do have some skin in the game. Versus like 1 month rent and 1 month security. No, it's more than that because this company is buying this home so that you can do what you need to do within the time frame. If you need 6 months, if you need a year, so that you can become mortgage ready. So they're taking on all the risks up front because they bought the home. And so once the client is ready and they're mortgage ready, they're going to step in and assume it. So yeah, it's not a traditional lease where it's just a month security.
I have one client that's going through their approval process now. So they're like updating me, like they applied, they need to submit other documents. So hopefully next week I'll find out if they are approved and how that works. So I haven't had any personal experience with it other than this one client right now.
Okay, and definitely if they're not working with a lender, I am approved through Trio. So the process when they apply, they get the applicant ID, and that's how Vanda is able to see the process and get the updates. And if they connect me as the lender, I can see the financial piece and I can get those updates as well to keep the client in the loop. I had a client that I did, and it was great because she was a business owner and she didn't quite understand how to do her P&Ls correctly. So I'm like, hey, well, this is the issue. Let me see what you're sending. And, we were able to work it out, and she resent and they said, oh, this makes sense. And, she was approved right away. So it's good there's a fiduciary, that word gets me, y'all. Y'all know what I'm trying to say. Help me out, somebody.
Fiduciary.
Yes, that responsibility. So they're not going to give the real estate agent too much of that, but as a loan officer, they will give that information to me because I hold to the same code of ethics. So it is great to have a loan officer on your trio deal as well.
Now, I didn't know that to go that route because they went with a couple of loan officers and, they didn't get approved, but I didn't let the loan officers know that they were applying to Trio. So I had to circle back around and do that.
Yeah, if you, I don't know if they're working with someone, I don't want to undercut anyone, but that loan officer has to be Trio approved. If they're not, if their loan officer isn't Trio approved, I'd love to step in and help out because it's, it's good to have that, to know what Trio is saying yes or no about.
Right.
And same way you connected yourself to the application is the same way as a loan officer, I'll connect myself.
Oh, good information. Thank you.
Yes.
Hi, can I ask a question? So how do they differ from Divvy?
So I don't work with Divvy. And from what I've heard, and it's a secondhand information, I think Divvy does not lock in. I don't know if the interest rate is locked in at the beginning with whatever Divvy. I think that's the biggest difference, the interest rate and the price of the home. So, with Divvy, you have that 2 years to lease or 2 or 3 years. They'll do another appraisal and whatever that market value is at that time. And this is secondhand information. I don't know for sure. I was told that Divvy will change the price, whereas in Trio, it's locked in, regardless of what the market did. Can you comment to, does Divvy do another appraisal, and on that back end, can they change the amount of the loan?
I'm not sure. I've only worked with Divvy as far as getting pre-qualification, but an issue I've had with Divvy is a lot of their decision is made on the monthly payment. And so the monthly payment, unfortunately, causes for a very low loan, which you can't find houses in the price that Divvy is willing to pay for in Houston.
I will say that with Trio, I can only speak about my experience. They do take a look at everything, the full picture. They vet the application like a mortgage. So I find that's good because that's how they're going to vet it the same way I vet it as a loan officer. So they're going to pre-approve you based on those debt to income ratios. I'm not sure about the monthly piece. I can ask and find out. But I know from what my understanding is, they're vetting the application as if it's a mortgage. That's how they're pre-approving their clients. And they, once you get that pre-approval, you can go out and shop. I've done new construction, actually, with Trio. I've done 2 new constructions. Now, I don't think that salesperson knew what they were doing, and they were upset when they got that assignment contract, but the salesperson had already signed it and it's executed and it was binding. So I have done new construction. Some of these new construction lenders are doing, and some of them are not. But I have done new construction with it. I like the fact that there's no inventory homes and you can go out and you can shop in the open market. You're not stuck to a set of houses.
Mm-hmm. Yeah, that's what my client wants. They want new construction as well.
Yeah.
Okay, good information.
Mm-hmm. Well, I know we went past the time, you guys. I got long-winded. I'm going to have to shorten this presentation.
Oh, you're fine. If anybody else has any questions, we can always email you or text you. And
Absolutely.
I appreciate you coming and doing this for us.
Absolutely. Thanks, you guys, for inviting me. I'm going to let y'all go and enjoy the rest of your day.
Thank you.
Bye.
Bye, everybody.
Thank you. Bye-bye.